Hang on a second. Okay, one of the first things I found myself doing when I started working at Western Sydney is having to teach finance out of a traditional finance textbook, which was an intriguing experience. And I think I really like the topic that Eve was given here, what not to learn, because what dominates the thinking about finance is still the whole neoclassical framework as applied to finance. And the core message, if you want to say what does that actually tell you, I think you can sum it in simply saying leverage doesn't matter. In either micro or macroeconomics, you're told the level of debt is irrelevant to the performance of the shares of the company and the performance of the macroeconomy as well. And if you look at the Modigliani-Miller theorem, which is one of the many elements that I found myself gobsmacked as I read, not for the first time, but realised this is being pushed out on second-year students in a finance course, that there's no premium for leverage. So leverage companies cannot command a premium over unlevered. Why? Look at the reason. Because investors have the opportunity of putting equivalent leverage into their portfolio directly by borrowing on their personal account. So leverage by the company can be counteracted by no leverage by the person who buys the shares and vice versa, and therefore in the aggregate there should be no importance for the level of leverage, either for the corporation or the individual, in setting the valuation of shares. Valuation comes down to just what you expect the expected net present value of the cash flow of the corporation to be. And then when you take the way that was applied in developing the whole capital asset pricing model, this is quoting from Sharpe and ultimately derives the result, given a set of assumptions, which I'll just detail in a moment, that in equilibrium there's a simple linear relationship between expected return and what they call risk, which is the standard deviation of the return, what he again calls efficient combinations of assets. So again, yes, there will be a relationship between leverage and return, but that is completely traded off by the risk that you know you're taking on at the same time. So it's a simple linear relationship. You don't need to worry about leverage apart from deciding where that determines you sit on your return and volatility trade-off, individual trade-off. And in the macro level, when looking at the role of private debt in the economy there, that's focusing more on how they analyse or how they explain the way that debt is created at the national level rather than individual shares. But you have Ben Bernanke pretty much dismissing Irving Fisher's debt deflation theory of the Great Depression. He works out a neoclassical version of it after doing this, and spends a bit of time on it, but generally speaking says that Fisher's argument that debt deflation is what caused the crisis was less influential in academic circles than it was in political circles, where Roosevelt took the idea seriously and stimulated the economy because of partly what Fisher argued to him. He says less influential because of the counter-argument that debt deflation represents no more than a redistribution from one group, debtors, to another group, creditors. Now think about that one for a moment. I normally dive right in and make a comment about how bright I think that is, but I'll let that one pass because I'm going to go on another issue later. He then says, absent implausibly large differences in marginal spending propensities between borrowers and savers, pure redistributions, which is how debt's regarded, should have no significant macroeconomic impact. So you can forget about debt at the individual level for determining the value of shares, at the aggregate level for determining the valuation of the market in general compared to the economy itself, and you can forget about it in macroeconomics. Which means this correlation should be zero. This is margin. This is looking at the rate of change of margin debt in the New York Stock Exchange and Robert Shiller's 10-year lagged earnings to price ratio. Correlation should be zero. Unfortunately, it tends to be 0.63. So that should be close to zero. Okay. And so should this correlation. This is looking at the relation of the rate of change of mortgage debt as a proportion of GDP compared to the Shiller's house price index, the change in that price index. Correlation there 0.77. That should also be zero, according to conventional theory, or close to, not significantly different from zero. Okay. And this one too, this is the relationship, again I'm talking not just the rates of change of debt here, but I'm talking acceleration of debt, an annual change in GDP. That should also be pretty close to zero, because remember, pure redistribution should have no significant macroeconomic impact, so there's a correlation of 0.76 between the acceleration of private credit and the change in GDP. And finally, this should be zero too. This is Japan for the last 25, actually make that the last 45 years. Correlation of this is now looking at change in debt and the level of unemployment. And the correlation over a 45-year period is minus 0.89. In other words, if you want to do empirically trash a theory, you couldn't do better than to trash conventional finance and conventional macro when it comes down to the attitude about leverage. And even if you use Milton Friedman's simplistic notion about methodology, this sort of stuff should be enough to say, well, we got that one wrong, what's the next theory? But of course, that's not what happens. So, and finally, another fun correlation, this is the United States going from 1990 to today, change in private debt and the level of unemployment, correlation minus 0.93. I'm not even trying to build a model there, okay? It's just saying these correlations, which should not be significantly different from zero according to neoclassical priors. Well, clearly there's something wrong with the neoclassical priors. And if you take a look at them, in finance, there's simply a false behavioural assumption. And again, I want to go well beyond Milton Friedman's simplistic notion about whether you should take which assumptions you should take seriously or not, or whether you should ignore them all. And that's where Musgrave's argument about what he called domain assumptions matter, where he said, yes, there's assumptions which are negligible. You could say leaving them out makes a small difference to the theory, and that's the way the neoclassicals normally defend the assumptions they make. You know, you don't want to have, and I literally had this conversation recently with David Adefalco, I think it was, on Twitter, who's a deputy president of one of the Federal Reserves. Very nice guy, very nice to correspond with him. But he made the point about, well, you don't want to have maps that include the trees you're going to drive past, do you, and stuff like that. In other words, leaving out the trees when you're showing a road map is trivial. But I'm not talking trivia here. I'm talking something that if it disappears, this assumption doesn't apply, the theory is in a shambles. Now, who am I quoting there? The guy who wrote the efficient markets hypothesis. This is Sharp talking in 1970 about the assumptions he used to build, let's say talking inside 1964 when he wrote the paper, saying to derive the conditions for equilibrium that are part of the idea of a linear trade-off between risk and return, we have two assumptions. The first one he calls homogeneity of investor expectations. Always looks good, doesn't it? Said investors are assumed to agree on the prospects of various investments, the expected values, standard deviations and correlation coefficients. So you couldn't have a conversation around a dinner table about share prices because everybody would agree with everybody else. You have to find something else to have controversy about, like Kim Kardashian and stuff like that. You know, you couldn't talk finance or house prices, there'd be no discussion. But writing 6 years later, Sharp says people often hold passionately to beliefs that are far from universal. The seller of a share of IBM may be convinced that it's worth considerably less than the sales price. The buyer convinced it's worth considerably more. So he's admitting that this is obviously an assumption that doesn't apply. Now, is it a negligible assumption? Does leaving it out make no difference to the theory? What if you take into reality into account and say that this assumption, if you change it, changes the results of the theory? Well, he says the consequences of accommodating such aspects of reality are likely to be disastrous. In other words, it's not like ignoring trees when you do a road map. Okay? The theory goes out the window. He says the capital market line no longer exists. There's a curve, linear over some ranges, but flatter as risk increases. There's no single optimal combination of risky securities. The preferred combination depends on what each investor thinks is going to happen in the future. The demise of the capital market line is followed by that of the security market line. Quote unquote, the theory is in a shambles. That ain't negligible, guys. Okay? But that's the way they defend assumptions, but when you honestly look at them, they're far from negligible. And equally, the macro argument that Bernanke made, that you can ignore what he called pure redistributions, is based on a false structural assumption about the nature of lending. This is quoting another favourite foil of mine, Paul Krugman, saying, think of it this way, when debt is rising, private debt, it's not the economy as a whole borrowing more money. Now, the Bank of England has said it's precisely the case that it is the world borrowing more money into existence. But he says, his point of view, it's simply patient people lending to less patient people. A redistribution, no creation of money involved in the whole process. And that's the loanable funds model, which is the prop for their reason to ignore banks' debt and money in a fundamental way when they do macroeconomic modelling. So the conventional model of loanable funds is that simply a patient person lends to an impatient person and the bank charges an intermediation fee, and that's the whole story. So I've just built a double entry bookkeeping view of this, and this, using my software Minsky, And if I had more time, I'd go through the reasons why I've got plus and minus there. But the basic idea is lending is for a consumer agent who is patient to an investment agent or sector which is impatient. That's the transfer of money. And there's repayment of debt also from the two parties, interest payments between the two parties. And the fourth line, a bank fee. That's the reason the bank exists, to do intermediation. Now that's a structurally false model of lending, as the Bank of England has recently come out very emphatically in saying it's a nonsense model of the actual nature of banking. It's not that banks aren't intermediaries, banks initiate loans, and when they create loans, they create money. So structurally it's false, but importantly, in a logical sense, it's correct. Because if that was lending, then debt wouldn't matter. And just to illustrate that, I'll put it into my Minsky software, and again, with more time, I'd dive into the details of the models, but I'll bring it up and show it on screen. And if I... let's magnify that. These controls over here let me change the rate of lending and the rate of repayment. I can change all the other values as well, but it's mainly interesting to show those. And if I run the model, notice the growth rate hits 0 pretty rapidly. If I speed up lending and slow down repayment, there are minor fluctuations, as you can see, in the growth rate. Down here you can see the level of debt rising dramatically, money being constant. And then if I have a rapid slowdown in the rate of lending and an increase in how fast people repay debt, you get a plunge in the level of debt compared to money, and also debt compared to GDP, which if the larger screen was here, you'd see that running on the graph over here. But trivial impacts on the rate of growth of the economy, changes in the velocity of circulation of money, which are reasons why you get little changes in the macro levels, but you can pretty much ignore the banking sector if that was the case. Huge change in the level of lending, no particular change in the level of economic activity. So if this was structurally correct, yes, it'd be correct to ignore banks. But what if they have a radical thought here? What if banks actually lend money? Well, I can show that in Minsky. Well, that's exactly the point. If I go into Minsky here, what I'm showing in the software is that debt is an asset of the consumer sector and a liability of the investment sector, which is nonsense. It's, yes, okay, there's some peer-to-peer lending. I've got 5 minutes to go, so I've got to really accelerate. Okay, but if I won't have time to do it quickly, do it slowly that way. If I make those changes and make it an asset of the banking sector, then I get dramatic changes in the growth rate given changes in the rate of lending, changing the amount of money, the debt changes the amount of money in the economy, you get booms and slumps in GDP. Now, why the difference? It's because lending money into existence by the banking sector doesn't just create additional money, it also creates additional demand and income, and that's something which has taken me a while to get a decent proof of. But I'm going to look at 3 situations using an expenditure table and say what happens when the bank lends money versus when there's a lending between on a peer-to-peer basis. Now, if you don't have any lending at all, well, the basic idea of the expenditure table here is that expenditure shown horizontally, incomes vertically. The negative of the diagonal is aggregate demand. Okay? Aggregate expenditure, pardon me. The off-diagonal elements are the recipients of that money. That's aggregate income. So I've got the identity of expenditure and income here. What happens if I inject lending in a loanable funds way into this? So I have Sector 1 borrowing B from Sector 2 and spending it on Sector 3, which means Sector 2's got less to spend on each of the agents. When you cancel that out, you get the same outcome as you have for no lending at all, because the B's up here cancel, the plus B here cancels with the minus B down here. There's no impact on the aggregate economy. But when you have bank lending going on, then Sector 1 borrows from a bank, the bank's assets rise, its liabilities rise as well. There's no offsetting change in Sector 2's situation. You get a plus B here with no offsetting minus B down here. And when you aggregate, you find aggregate demand and aggregate income are both increased by the change in debt. And that's the essential point. The change in debt doesn't just create new money, it also creates new demand when it's spent into the economy. So aggregate demand and aggregate income have to be regarded as having at least 2 components. The first being demand and income from the turnover of existing money, plus demand and income from newly created money, and also, as it happens, aggregate financial transactions. Now, when I look at a flow of lending rather than just one-off, and so it says a flow of lending over time, so I'm dimensioning change in debt per unit of time on the basis of borrowing per year, I now have a rather more complicated picture here, and pardon me racing, but I've given a 5-minute sign about 4 minutes ago, I think, so I'm really under the gun here. This is showing, this table shows the S1, S2 and S3 I'm now treating as bank accounts, the amount of money that those sectors have in their bank accounts. That is expenditure financed out of turnover existing money, which turns up down here in the aggregate demand and aggregate income statement. This is change of debt, which turns up over here. And you then have gross financial transactions, which turn up down here. So your full statement is that aggregate demand and aggregate income are non-debt financed expenditure, plus the change in debt, plus gross financial transactions. So you've got to include change in debt and financial transactions to get the aggregate level of demand. And of course you've got to include asset purchases inside there as well. So you go from Milton Friedman's static equilibrium and exogenous money vision of the velocity equation, price times output equals velocity times money. The dynamic one includes the change in debt and gross financial transactions. And that's derived directly from an expenditure table. So with the dynamic vision, we get a very, very different view of how the world operates. Now, again, because with acceleration, when you look at change in GDP, you get the acceleration of debt turning up as a factor in change in expenditure on GDP and also on assets. So that's the reason why you saw those correlations earlier. It's a causal argument behind those correlations. So you need a monetary vision of capitalism where you've got to include finance as well as GDP. You can't hermetically seal the two as conventional economic theory does. And that makes private debt a huge omitted variable in mainstream economics, which is why they didn't see the crisis coming. It wasn't because it's unpredictable, it's because they left out the variables that caused it from their own models. That's why they couldn't see it coming. Now, of course, Minsky had them in there, and this is my reading of Minsky starts from this particular phrase where he says, the natural starting place for analysing the relation between debt and income. Now, in conventional theory, there is no relationship. And a lot of post-Keynesians as well, by focusing on the expenditure is identical to income argument, couldn't see a role either. But it is there when you simply derive it from expenditure tables. And what you then get out of this is the argument that capitalism is inherently flawed. Okay. Because it can finance and it generates a signal that induce an accelerating desire to invest as well as a capacity to finance that investment. So all this turns up in Minsky. And I want to finish with an insight about the nature of inequality coming out of debt as well, which is another major factor for developing countries. Because when I built a model of Minsky, it boiled down to 3 equations, and I've only recently worked out how to verbally describe the third equation. That's a set of equations, the first describing change in employment, the second change in wages, share of output, and the third change in the debt to GDP ratio. Now, that looks incomprehensible, usual sort of thing for a set of equations, but it actually boils down to 3 irrefutable statements. The first one is the employment rate will rise if economic growth exceeds the sum of population growth and growth in labour productivity. That's a fact. There's growth rate and there's population and labour productivity. The second one boils down to saying the wages share of output will rise if money wage demands exceed the sum of inflation and growth in labour productivity. There's money wage demands, there's labour productivity, and there's inflation. Again, that's a fact. And the third one is that the private debt to GDP ratio will rise if the rate of growth of private debt exceeds the sum of inflation and the rate of economic growth. And that again is a fact. That's the rate of growth of debt, that's the real growth rate, and that's inflation. Now, it's pretty hard to argue with irrefutable statements. I may have left out some important additional components, but that's what it boils down to. What sort of behaviour does it give you? Well, this is where complex systems comes in because, again, as I said, disagreeing with those statements is like disagreeing with gravity, not good for your health. But you could never deduce the behaviour of the system just from those verbal statements. You have to simulate it. So when I simulate it, I get this sort of dynamic. That's inflation on the vertical axis, unemployment on the horizontal. Notice it seems to be spiralling in towards a nice equilibrium point and then suddenly goes up here inexplicably. What happened in the data? This is looking at the American data over the last 25 years. Same basic pattern, spiraling in and then bang, out here. Inexplicable. But if you take a look at them in a third dimension where you include debt, then you get that type of dynamic. It's worse when you include assets, shown. It happens more rapidly. And this is looking at the level, in the data as well. The same trend for rising private debt sitting behind it was driving the whole behaviour. And you get a very, very similar qualitative behaviour out of the model in the economy. So what you've got, and it's best mentioned that it was worse when you include debt finance speculation, that the crash occurs rapidly. So that particular part of the behaviour of the system is not something Minsky had as a verbal prediction. He did say stability leads to instability, but he didn't predict a period of apparent great moderation prior to the crisis. That comes out of the complex systems nature of the model, which is known as the inverse tangent or Pommeau-Maniville route to chaos, as it happens. And there's emergent properties which I'll finish on, because there are three system states, as you saw in the model. There's the employment rate, the debt ratio, and the wages share of output. When you solve for the equilibrium, and I haven't properly put this in published papers yet, there are three components there too. But they're the employment rate, the debt ratio, and the profit share of output, not the wages, even though in this model the capitalists are the ones doing the borrowing. What it means is workers' share is a residual after profit and debt servicing. So they are the ones who pay for the higher debt levels, not the capitalists, even though I haven't got them borrowing in this model at all. They're the ones who pay by getting a lower wages share. And equilibrium, predictably, in a non-neoclassical world, it's unstable for realistic parameter values. So what you get is falling wages share offsets rising amount going to bankers until such time as you get the maximum rate at which wages can fall, and then if the conditions are such that the interest rate and the deflation rate mean debt compounds at a faster rate, then finally capitalist profit falls over. So when you graph it, you get this sort of behaviour. Trend down in workers' share. Profit looks like it's stabilising, and then it collapses here because finally at this point the exponential growth of debt overwhelms the system. And so from capitalist point of view, everything's hunky-dory until they go bankrupt without warning. That's the nature of capitalism. So the real question about neoclassical economics in the mainstream is not about what to unlearn, is what not to unlearn. Because leverage plays an essential role in macro. And of course, when you include that the main source of debt growth is to finance asset purchases, you get a strong two-way link between macro and finance, with the markets being far from efficient as the conventional theory argues. And if you want empirically accurate descriptions, look to what's called the fractal markets hypothesis, or the inefficient markets hypothesis, or what econophysicists are doing about power law distributions. And ultimately, my punchline is that Sharpe actually is right about one thing: the mainstream theory is in a shambles. Thank you.